Our next concern is to have a look at session 6 in the class notes, the irrecoverable debts and provisions for doubtful debts. That is our concern. Now, I need to explain this in the context of the overall picture. If you remember, we do our little journal entries if the business is quite small. Those journal entries, be they debits or credits, are posted up, are transferred, written into, the accountancy term is posted up. You post it into these little T accounts, these T ledger accounts. These T ledger accounts are then balanced, especially where you have several items in each account. These balances are then extracted from those little T ledger accounts, and they form then a list of balances that is called a trial balance. You try it to see if it balances. Of course, if you've done your sums correctly and if you're careful, it will balance. Now, before that trial balance, which remember came from the ledger account, which came from original books of entry like the journal entry, if that trial balance balances, you then need to adjust it for things like depreciation, revaluations, possibly disposals, inventory, particularly the closing inventory. And here you have another adjustment. This is known as irrecoverable or bad debts, and of course provisions for doubtful debts, sometimes described as allowances for receivables. Okay, so you're looking at your trade receivables and you're scrutinizing them, looking at them very closely to see whether they should be written off as uncollectible or whether you ought to be prudent, sensible, and keep some money aside, 5%, in case 5% of that receivable total figure don't actually pay you. So what's a receivable? Basically, they are customers with whom you've done business on credit, and they haven't quite paid you by the year end, or maybe month end. But let's concentrate on trial balance being done once a year, and the final accounts obviously being done once a year. So that's a general scenario. We're dealing with an adjustment to the trial balance. So if you turn please to that page, it should be about page 41 in your notes. This is an adjustment to the trial balance. Adjustment to the trial balance. Clearly, where you have these 2-mark objective test, multiple choice type questions in the computer-based exam, 2 marks is perfect material for the examiner to say to us, can you work out what the charge to the income statement this year is, given that you have a provision at the end of this year compared to the provision at the end of the previous year. So the difference between the 2 year ends goes to the income statement. So it's perfect material to be examined regularly, maybe several times in your exam, for 2 marks each. So it's one of those things that you must expect in the exam. It's very easy, by the way. So let's give that a quick read, just to get familiar with the general scene. You should be able to explain the difference between an irrecoverable and a doubtful debt. So near the word irrecoverable, I'd like you please to say bad. Bad or irrecoverable. A doubtful, of course, is something that's nearly bad. It's showing bad signs. You then have to be able to compute the double entries for irrecoverable debts and the provision for doubtful debts. Now, this provision for doubtful debts, sometimes described as allowances, allowance for receivables. Be ready for either expression from the examiner. Introduction. The majority of companies sell their products on credit. I'm going to underline on credit. The length of credit will vary between companies, but the most common length is about 30 days. But there's nothing rigid about that. It depends on the company's trading position. If, however, someone fails to pay, we need to be able to account for this in our ledgers. It would not be prudent to hold a receivable in our statement of financial position if we are aware that they are unlikely to pay. So underline that, prudent. It seems sensible accounting to keep aside some money in case the receivable goes bad. Or indeed, if we feel the receivable is bad, you just write it off. Because it is incorrect to carry an asset in your statement of financial position where you know you're not going to convert that asset into cash, an economic resource. Now, there are two types of debt that we need to consider: irrecoverable or bad debt, and of course, as we were saying, doubtful debts. There is obviously a clear distinction between the two. So what's irrecoverable debt? I might write nearby bad debt. This is a debt that you consider to be uncollectible. Please underline that. Uncollectible. Circumstances where this would occur are if the company has been, the receivable has been fraudulent, gone bankrupt, disappeared, etc. Thus, it is unlikely that we will receive our money back. So that's an important word again to underline, unlikely in our opinion. If this is the case, we should not have this balance in our receivables and would therefore write the debt off. So what's a double entry? As you can see there, the irrecoverable debts, statement of comprehensive income, income statement, so you debit your income statement, and clearly you credit your SFP, statement of financial position. And so we look at our first example, just to make this come to life. So George has a small antiques business. That's us. We are George. And at the end of the financial year ended 30th of April 2007, has a receivable balance of 42,500. Might underline that. Receivables balance of 42,500. Included in the year-end balance is 4,000 that is owed by Zippy traders. George has heard that they have been closed down due to financial irregularities. Oh dear. And that all the directors have disappeared. This gets worse. Zippy is bad. What's your feeling? So let's write, therefore, Zippy or Z is bad. In other words, a bad debt. Let's read the second paragraph. Also included in the amount is 500 owed by Bungle, who is George's brother-in-law. Bungle, the brother-in-law, has left George's sister. Now, you may consider George to be a bad person for leaving your sister, or shall we say Bungle to be a bad person for leaving George's sister. But Bungle is not yet actually a bad debt. George, therefore, is not sure if he will pay his debt, which is due in 2 weeks' time. So, what shall we do? The way to answer this, I suppose, it says there, how should George account for these items? I'll tell you what we'll do. Let's write out a bit of an answer so I can explain how these items are dealt with. Here we are. Irrecoverable debts, example 1, called George. Irrecoverable and doubtful debts. Systematically, we go through the facts. The first bit, I suppose, is that Zippy should be written off as irrecoverable or bad debt. So how to convert that idea into a journal entry? Debits and credits, the language of accountancy. We're going to therefore debit the income statement with the irrecoverable debt, 4,000. Have a look. Yes, 4,000, where these are dollars. And the credit goes to trade receivables, which is obviously the statement of financial position. And that credit is for $4,000. It's fraud, and therefore it's written off. So I might just say in brackets below that, fraud, therefore written off. In other words, you feel you're not going to get that money. The directors have disappeared. So let's leave a line as we face our next situation. So I'm going to do that as a little bullet point. This is bungle. How shall I approach this? Lots of little explanations maybe. Be clearer for you then. Default has not happened yet. Do you agree? He might have run away, leaving your sister, but you, George, are not sure whether he's going to pay yet. And the reason, of course, is the debt is due in 2 weeks' time, and those 2 weeks haven't yet passed. That's the concept. Default has not happened yet. It's due in 2 weeks' time. Let's pick up some more points here. Also, B might still pay. Also, bungle B might still pay, i.e., despite not being in a brother-in-law type relationship with you, comma, on a purely commercial basis, it is too early to be called even doubtful. I put that in inverted commas. What else can I say? Just to conclude matters, B is not in financial difficulties. B is not in financial difficulties as far as we are aware. Though he may be in romantic difficulties. So all in all, one could come to the conclusion, I suppose, it's too early to be called doubtful. Wait until the next 2 weeks have passed and then reassess. So I'm going to write that in. Therefore, not yet doubtful. It's not yet doubtful. Wait until next 2 weeks have passed and then reassess. Absolutely straightforward, as you can see. A very practical issue, especially these days where several companies are in difficulties, in a bit of an economic downturn in different parts of the world. So something like doubtful debts, bad debts, very likely to be examined. I turn your attention, therefore, back to page 42 as we have a look at recovering debts written off. So I've done George with you, example 1. I'm now looking lower down the page at the next issue. Recovering debts written off. If a debt that has been written off is later recovered, emphasize the word, if you would kindly, the word later. In other words, if I can revert to our friend Zippy upstairs, Zippy owed us 4,000. Let's say out of the 4,000, 1,000 is recovered. We will need to adjust the ledgers to reflect this. The entry required would be bank, debit. Is that because money is coming in? So I'm going to say money coming in, say 1,000. And obviously the irrecoverable debts or bad debts, you notice, normally is a debit. It's a charge. By crediting it, you're doing the reverse. Indeed, it is being reversed because out of the 4,000 that you wrote off, 1,000 has come back in. Now, how about if you have doubtful debts? Let's read on. We've dealt more or less completely with irrecoverable or bad debts. We're now moving into doubtful. In other words, the level of certainty of it going bad is a bit less than had it been a bad debt. A doubtful debt is a debt that is owed to a business, but they are dubious, not sure about its collectability. The distinguishing factor is that this debt could be collected. Notice the word could. A little bit of doubt about it, hence the word doubtful. As it is doubtful, not bad. We therefore make a provision for this amount, just in case, and of course, it's always a credit item, by the way. So you notice here we have a credit called provision for doubtful debts, and that goes to the statement of financial position, sometimes called allowance for receivables. Provision for doubtful debts, or also known as allowance for receivables. I've just used some abbreviations there. So you debit your irrecoverable debts in the income statement. So the income statement is debited and the credit goes to the statement of financial position, which is the balance sheet, of course. This type of provision is called a specific allowance, as we know exactly which debts the provision is for. As you can see, the debt remains in the receivables ledger. As a result, the company can still actively chase the debt. If or when the company pays the debt to us, the double entry would be the normal entry for a receipt. As you can see there, debit, money coming in. So I'll say in brackets, debit bank, money coming in. And credit trade receivables. I suppose the reason is we are expecting less in the future as a result. And so we would reverse the provision we had for this debt. Let's read on a little bit more. What do we have ahead of us? As we were saying just now, we would reverse the provision we had for this debt. Now, I need to explain what a general allowance, a general provision is all about. Okay, so this is a general provision or a general allowance. We say there, in order to apply the prudence concept, might underline our old friend prudence. It's one of the fundamental concepts in accounting. We need to review our receivables at the end of the financial year and take a view, form an opinion of the collectibles. A large number of companies have a constant provision for receivables. This would be calculated as a percentage of the receivables balance. Now, where's all this information coming from? Now, as we will see in due course, every time there's an invoice, it is entered into a book of prime entry, as they say. In other words, a source document. An invoice goes into something called a day book. That day book, either through the journal or directly, goes into little T accounts for individual customers who haven't paid us yet. We've sold them goods, they haven't paid us yet, so we have assets. Now, all these little customers added together becomes the trade receivables figure as at the year end. So the company at the year end decides, this is my trade receivables. Now, would you agree that some of those trade receivables, upon careful examination, may be felt to be bad? In other words, irrecoverable. It is not possible to collect them. Uncollectible. Why? They might have been like our friend Zippy in liquidation or whatever the problem might be. The directors might have disappeared and they refused to pay. So you start with a large figure. You then write off the bad debt. So that large figure becomes a bit smaller. You then look at the smaller figure and say, well, the company's policy is to charge, say, 5% of that reduced figure. Remember, it's a bigger figure. The bad debts have been written off, so it's a smaller figure. But as you look in detail at the smaller figure, the company might choose to provide 5% on the whole lot because they aren't sure whether one particular item, 5% of the total, might go bad, or whether, generally speaking, on average, based on experience of several years, that 5% is a good percentage to keep aside. Okay, so I'll just run through that once more. You have the total of receivables. You write off some of it as a bad debt, and what remains, you decide to examine further, and just being prudent and sensible, you provide 5% of that. Now, would you agree you would have done that at the end of last year? You then trade during this current year, and there's lots of activity, and then at the end of this year, you find yourself with another big total of receivables. Again, you write something off, perhaps other customers' circumstances might have changed. And so you provide 5% of the year-end balance. You then compare the two balances at the start, at the end of the year, in respect to the provision, and any difference goes to the income statement. Now you must understand that concept. So we say that a large number of companies have a constant provision for receivables. This would be calculated as a percentage of the receivables balance. You see? And so we have our example 2 ahead of us. For the year ended 31st of December 2005, a company's receivables balance was $150,000. They had a general allowance of 5%. Immediately I'm saying to myself, if I was facing that computer screen in the exam, 5% of 150 is, you're right, 7,500. You then have your 135,000 given to you at the end of the current year. In other words, between 2005 and 2006, a year has passed. You look at your 135 at the end of the current year, and you multiply that by 5%, or whatever percent the question might choose to give you. For the sake of simplicity, we've left the 5% the same throughout the year as a company policy. The directors feel it should always be 5%. So don't forget what's happening here. You have a huge figure for receivables. Some of it has been written off as a bad, irrecoverable debt. What remains at the end of last year is 150,000. 5% on 150,000 is 7,500. You then come to the end of this year, and you similarly start with a large figure of receivables, depending on whatever trading has occurred during this year, etc. So you have a large figure for receivables. Some of it is a bad debt, so we forget that. Whatever's left happens to be 135,000. So we then start thinking 5% of 135,000, 6,750. And so if at the end of last year we provided 7,500, and at the end of this year we provided 6,750, clearly you can see that the receivables figure has gone down. Or shall we say, the receivables provision figure has gone down. And so that is the nature of what we are doing. So what is the impact, says the question, on the income statement and, of course, the statement of financial position? And I need to show you how all this works. So let's open up a little page in our class notes as we attempt this exercise, please. Here we are. Example 2. Something to do with general allowances. Also known as provisions for doubtful debts. One or the other will be used. Very likely to be examined because it's very practical. It has tremendous usefulness in real life accounting. So expect it. So how shall I do this? Clearly you have an opening balance which is 150,000, it's all dollars, let's get rid of that worry, 150,000 multiplied by 5%, which is clearly 7,500. We'll then compare that to the closing balance. $135,000 multiplied by 5%, 6,750, which when compared to the 7,500 gives 750. So the 7,500 was at the end of last year, 6,750 at the end of this year. So obviously we've got 750 too much in the account, so we've got to get rid of it. How do we get rid of it? That's what I want to explain next. So you remember some of these journal entries? I'm going to debit the provision for doubtful debts or allowance for receivables, 750. Oh, a provision is a credit usually. Provisions are credits. They're like liabilities. So if a provision is a credit and you want to reduce the provision from 7,500 to 6,750, the provision, which is a credit, must be reduced. How do you reduce a credit item? By debiting it. There you are. Debit the provision. And of course the credit goes to income statement. The way I understand it, I suppose, is last year we provided 7,500. This year we don't need as much. So whatever last year suffered, we put back a little bit to income statement. But remember, the 750 is in respect of new information that has come to light this year. So this year enjoys the benefit of it entirely this year. So you mustn't correct the previous year. It must be reflected in this year's results. And to me that seems fair. Okay, the credit goes to income statement. It's like sundry income, I suppose. What else can I say? I suppose last year that 750, beg your pardon, 7,500, that 7,500 last year was a debit to the income statement and a credit to the provision account or allowance account, assuming there wasn't anything the year before. Big assumption, of course. So it wasn't a provision previously, it's a brand new company maybe. At the end of last year, you debited income statement and you credited provision. At the end of this year, because you had a last year, you've got to be a little bit careful here. The only entry you need is to reverse, cancel, turn upside down the earlier debit income statement credit provision. So how do I turn that upside down? Instead of saying credit provision, I say debit provision. And earlier we said debit income statement, now we say credit income statement. And that surely is what we did down here. Let's just have a quick check. Yes, indeed. Look at that. Debit provision and credit income statement. Now, what else can I say? That's my income statement more or less under control. What I need to do next, of course, is a statement of financial position. It comes in under current assets. Where you show your inventory, that kind of thing, and cash balance. And so you have your receivables, trade receivables of 150,000. less the provision, or as it's called, allowance for doubtful debts or receivables, and that is, how much is that? You're right, 5%, 7,500. So if I do a net figure comparing those two, I find myself with 142,500. Now, please be careful, that's at the end of the first year. So let's say at end of year 1, assuming it's a brand new business. Now, at the end of year 2, as you'd imagine, we have a trade receivable of 135,000, which is then reduced by the allowance or provision, and that is, whichever word you wish, is 6750. Just write that a bit more neatly, sorry. Take one away from the other, that is 128,250. Please be careful to acknowledge that the figures of 142 and 128, etc., is only for presentation purposes. You don't actually reduce them from the receivables figure in the proper ledger accounts. So can I just make that little note here? Exam point. Offsetting provision against receivables total is for presentation purposes only. Do not do journal entries, JEs, for these. Of course, you do a journal entry for the provision being reduced. That is unavoidable. So what I'm saying is, by reducing 7,500 provision from the full figure of 150,000, I'm not actually writing it off as if it was a bad debt. It's quite important to realize the difference. So it's quite possible that the original figure at the end of last year was 155,000. 5,000 was then written off as a bad debt, and then you had 150 left, on which you take your 5%, 7,500, to leave you with 142,500. Is that right? So there's a big difference between the amount written off as a bad debt and the amount simply kept aside by way of a provision or allowance. And that keeping aside is reflected in the current assets by saying trade receivables, the figure after bad debts, minus the provision. And so you have the net receivable shown as a proper asset in the statement of financial position, because that is indeed what you're expecting to receive. All right, so that brings us to the end of our little session on doubtful debts. The reason why I've spent a few minutes on that, extra minutes on that, is it has a tremendously good chance of coming up in every exam sitting, because it is so easy to draft questions for 2 marks on something like this. All right, so ultimately, where does this fit into the context of what we're doing? We've been doing those little T accounts from which we produce the trial balance. That trial balance is then adjusted for things like depreciation, revaluations, disposals, indeed, closing inventory. And before you finalize the accounts, one more adjustment you make to the trial balance, alongside things like closing inventory, is, of course, this first bad debt written off, and then the doubtful debt provision. Okay, so be ready for terminology. Things are changing very fast, especially under the international variant, which is what you're doing. The examiner might well use slightly more old-fashioned expressions. She might say bad debts rather than irrecoverable, or vice versa. She might say provisions for doubtful debts instead of allowances for receivables. So be prepared for both styles of terminology. If you're not sure, guess. But you must always, in that exam, attempt every question. So the rough number of marks, or the rough number of minutes per mark, I should say, is 1.33 minutes per mark. So you have about 2.5 minutes to sort out a little doubtful debt provision. It should be possible, and you should do extremely well in that exam.